Hi everybody, let's talk about hedging strategies in this video. So there are two types of hedging strategy, a covered call and a protective put. We will be talking about a covered call in this video. Now hedging is a technique that is frequently used by many investors and option traders. The basic principle is that it is used to reduce or eliminate the risk of holding one particular investment position by taking another position. It's not an investment technique which is used to make money. The versatile nature of option contracts make them particularly useful when it comes to hedging, and they are commonly used for this purpose. So many investors that don't usually trade options will use options to hedge against an existing investment portfolio of a stock. So there are few option trading strategies which specifically can be used for this purpose. We will be talking about covered call as just said. So the principle of using options to hedge against an existing portfolio is quite simple, because it basically involves buying or writing of options to protect an existing position. So a covered call is an option strategy where an investor holds a long position in a stock and sells call option on the same stock in an attempt to generate increased income from the asset. This is often employed when an investor has a short-term neutral view on the stock, and for this reason he holds the stock long and simultaneously has a short position via the option to generate income from the option premium. So we can initiate this strategy by S plus, that is buying spot market, and simultaneously doing a C minus, that is selling a call option. This strategy is not useful for a very bullish investor. It serves as a short-term small hedge on the long stock position and allows the investor to earn a premium. So the break-even point of this strategy will be the current stock price minus the premium received from selling of the call option. The maximum profit is limited, that is strike price minus the current stock price plus the premium received from selling the call. And what's the maximum loss? You receive a premium for selling the option, but most downside risk comes from owning the stock, which may potentially lose its value in case the market crashes. So in fact, selling the option creates an opportunity risk. That is, if the stock price skyrockets, the call might be assigned and you will miss out on those gains. And as the call is sold at a higher strike price, so loss from a call sold, that is C minus, will be offset by the stock which you are holding by an S plus as the price is rising. Let's understand this better with the help of an example using elearnoptions.com. Let's have a look at the payoff diagram of a covered call strategy using elearnoptions. Now logging onto the website, when we click on the covered call strategy, we can see a payoff diagram over here where I assume that the future price or the spot price, whatever the case may be, say we are long on that, we have purchased one future lot or shares in the spot market at say 10,000. We can change this to any value. Let us stick to 10,000 in this case, and simultaneously we sell a call option of the same underlying at the strike price of 10,000. The call premium here can be adjusted, so let's assume that the call premium is 100. So basically my strategy is that I am long on the underlying in the futures market at a price of 10,000, and simultaneously I sell a call option of 10,000 strike price by receiving a premium of 100 rupees. So we can see the payoff diagram over here. If the price remains at 10,000, my profit and loss would be 100 rupees as the call option would lapse, and the premium will be my profit, and there is no loss occurring from the future price position. Similarly, if the price increases, say if the settlement price on the expiry date is say 10,200, my profit and loss from the strategy is fixed at 100 rupees. Why? Because the call option is exercised, the 10,000 call option which we had sold. Loss occurring from the call option sold will be 200 rupees. Okay, and simultaneously that loss would be covered from the future position which I have taken. I am already long on the option. So every rupee rise above 10,000, the loss from the call option will be nullified by the futures buy position, and we have a fixed profit of 100 rupees premium. Now if the price goes down, then we get premium from the call minus the value which has deteriorated from our buy price from the futures contract. So suppose for example if the settlement price is 9850, so we are incurring a loss in the futures position, that is 10,000 minus 9850, and that is 150 rupees, and 100 rupees premium which we have received from the call. So total PL is minus 50 if the settlement price is 9850 at expiry. Also, one interesting thing to note over here is that a covered call strategy is similar to a short put. If we look at the payoff diagram, this payoff diagram is exactly similar to a short put option contract. So we can say that a covered call can be also referred to as a synthetic short